dividend to the government this year compared to 2.69 crores last year. So almost an uptick of slightly more than 6.5%. We've got experts joining us on the show. Mr. Dhananjay Sinha, the CEO and co-head of equities at Systematics Group. We also have Mr. Gopalan, the former finance secretary, joining us on the show. Mr. Sinha, let's come to you first. Give us your sense on this number at 2.87 lakh crores. While, of course, this is higher on a year-on-year basis, like my colleague Ankur was mentioning, the balance sheet coverage has reduced from 7% to 6.5%. How are you reading into this number?
So I think it is definitely higher than expected, versus last year's 2.69 lakh crores. It's higher, somewhat higher, I would say. But important thing is that the contingency provisioning has actually been brought down from 7.4 to 6.5%. That, I think, has been a major contributor. So if you look at a back calculation, if it has actually added to roughly about 1.3 lakh crores or 1.35 lakh crores, then if the ratio was unchanged as last year, that is around 7%, then I would say the provisioning from the core operation would have been much lesser. So I think a reduction in the provisioning ratio is a major contribution, I would say. Roughly half of it is coming from there. Important thing is that last year, RBI's intervention in the currency market has been much lesser than the previous year. So if you look at FY25, the overall transaction buy and sell in the foreign currency market has been of the order of $760 billion, almost like 133% of the foreign currency assets. So I think this year it was much lesser. My last calculation was that it was about 70% lesser. So I think from the trading profit, it may have been much lesser. So I think if you exclude the reduction in the provisioning, the dividend payout would have been much lesser. So clearly there is a contribution that is coming because the government finances have to be met, and RBI has decided to reduce the provisioning ratio to deliver the dividend.
Okay. Hi, Dhananjay. This is Harsh here.
Sure.
Okay. Dhananjay, just very quickly, largely in line with what was penciled in, right? No surprises per se in a significant fashion.
Right.
Okay.
Yeah.
Dhananjay.
I think the composition is more important to really understand.
Correct.
Because the annual report will tell you how the dividend has been paid. So the number was floating around prior to the announcement. So I think broadly in line with what was expected, but I think the announcement gives us some detail about how it has been managed.
Okay, thank you so much, Dhananjay, for coming in and speaking to us. Let me bring on board Mr. R. Gopalan, and this will give us great perspective. Former finance secretary, he's on the phone line with us. What does this number mean, sir? It was largely penciled in, but give us some perspective in terms of the breakup and the like, if you were overhearing that piece by Dhananjay.
Yeah, what Dhananjay mentioned was, correct.
Yeah.
What has happened is that earlier, some time ago, the contingency buffer used to be between 5.5 to 6.5. Earlier, the permissible range was that. And there were times when you used to do 5.5 and sometimes reduced to 6.5. I think this permissible range was widened in 24-25 to 4.5 to 7.5 of the balance sheet. That is, RBI revised the economic capital framework in 24-25 and increased the contingency buffer to 7.5, from 4.5 to 7.5. That was the range they had fixed in there because of the various uncertainties that were there, and then the economy was going through a roller coaster kind of a thing. So it was fixed that way. I mean, maybe it was for 24, 25 it was fixed. Maybe another 5 years this will be followed up, and later it can be revised by RBI in consultation with the government. So that is how it operates. Now, last year it was 2.69 lakh crores. This year it's 2.87 lakh crores. Now, the reason why in the foreign exchange transactions, the trading transactions have been of a higher volume compared to last year, and therefore profits there have also gone up. And that's the reason why they could afford to give so much, about 2.87 lakh crores as dividend to the government, though the contingency buffer now is retained at about 6.5 rather than the maximum of 7.5. So since I told you from 4.5 to 7.5, they can, have the contingency buffer, and this time it has been fixed at 6.5%, which is okay. In my view, it is okay. And there are times when there is a requirement for supporting the government. There are sometimes these are required, and RBI has seen that in this times when there is a requirement of funds by government for its budgetary purposes, they have stepped in. But this is not a surprise for me. I thought when they penciled in about 3.1 lakh crores in the budget this year for this dividends and this RBI dividend, other dividends put together, I knew that there was going to be some increase this year from RBI, and therefore I'm really not surprised at this number.
Makes a lot of sense, Mr. Gopalan. Thanks for putting that into perspective, but also help us understand what kind of legroom does this transfer, such a big dividend transfer, now give the government in terms of its capex plans or liquidity management programs? How does this aid the government?
Okay, the government has a borrowing program which is announced every 6 months, and therefore it is there. And this is also factored into account in a sort of way. It is factored into account. This is supposed to be declared in any case during this period of the year. That May, June is supposed to be declared during this period. So government would have taken into account that receipt in its liquidity, in its cash management, and accordingly would have gone in for borrowing as required for various programs. The important thing we should watch this year in government spending is that is the government mechanisms or constituents of the government, will they be in a position to spend so much on the capital expenditure this year, which is required to be seen. But my personal view is that this is a time when the economy is likely to see a bit of a lower growth. This is possibly a time when government's capital expenditure should be maintained as per the budget they were provided for. The budget has carefully taken into account the ability of the government organizations and government itself to spend. And this time, this has to be done because the other investment, in my view, is not likely to, the private investment, in my view, is not likely to go up the way we think it should. So, government's capital expenditure this year will certainly be higher, but let us see how the state governments are able to do. I mean, state governments last year I don't think they did a very good job. So let us see how they are going to step up their capital expenditure, because that is going to be a very important factor in the entire capital expenditure program of the whole government.
Right. Mr. Gopalan, hi, Ankur this side. I want to understand from you the contingency risk buffer part. Now, this is something which last year Reserve Bank of India went with 7.5%. This year, they have committed 6.5%. How do you see overall this move in considering the scenario where we are in, especially the geopolitical tensions?
Well, you see, one would like to see a 7.5 like what it was last year. But with a 7.5 and 6.5, there's not much of a huge difference. I would have been concerned if they went down to 4.5. That would have been a little too far-fetched. But striking a middle listing of 6.5% is not a bad idea at all. And that gives the kind of, buffer which RBI really, requires. And I'm sure that there are, this year, for the year 26-27, I'm sure the incomes of RBI will certainly go up given the kind of forex transactions that are taking place and liquidity transactions that are required to be carried out. So I'm sure that there will be enough income this year, but 1 year going down to 6.5%, in my view, is not a thing which we need to be worried about.
Let's also welcome Gaura Gupta into the conversation. Gaura, hi. You would have seen the record surplus transfer numbers. First and foremost, how do you see the number itself? And more importantly, we are discussing the CRB, which is kept at 6.5%. What is your reaction on taking a step back and going for 6.5% instead of 7.5%?
I think that was expected, that they will have to reduce the risk buffer because the balance sheet expanded by 21%. So the risk buffer is a proportion of the balance sheet size. If they hadn't reduced the risk buffer, then the provisioning would have been higher. Even now, with a 6.5, the provisioning is of 1 trillion. Last year, they had provisioned around 450 billion. So it was expected that they'll reduce provisioning. It's not a big issue because if you compare other global central banks, RBI has the highest capital ratio. If you look at DM central banks, they're actually working with a negative capital ratio. So reducing it to 6.5 in this sort of volatile environment, it's not an issue. I think what they tried to do is ensure that they at least meet what is budgeted in the revenue that was the dividend that was budgeted in the union budget, which is exactly this much. So it unfortunately doesn't give too much of a fiscal room to the center, which is facing fiscal slippage risk because of the West Asia crisis.
Definitely, and we'll continue with this discussion. Gaura as well as Mr. Gopalan, please stay with us. We have to take a mandatory short break, but we'll be right back.